Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill speaks with Daniil Shapiro of Cerulli Associates to explore significant trends shaping the asset and wealth management landscape. Shapiro, with a background rich in risk management and product development, offers a comprehensive overview of the challenges and opportunities within alternative investments, ETFs, and the evolving demands of the advisory market. This episode not only addresses the intricacies of alternative investments and their place in retail and institutional portfolios, but also underscores the necessity for innovative approaches to meet the changing needs of investors and advisors alike. Listen in.
Daniil Shapiro, welcome to Educational Alpha.
Bill, thank you so much for having me on your podcast.
No, my pleasure. I've been a big fan of Cerulli and the work that you put out probably long before I met you, but you and I have bumped into each other on the circuit. I think both Cerulli and Chi are trying to bring greater transparency to try to solve for the best outcomes around democratization. When I think about best outcomes, maybe less so focused on the advisor and more on the individual investor. And I think we're going to spend the bulk of our conversation talking about that. But maybe it would be helpful to start with a little bit of your background.
So I grew up in the risk management landscape. I had a number of risk and compliance roles in HSBC's investment bank. I graduated right into the financial crisis and went on to the HSBC. From then, I had a risk management role in the consulting practice at Accenture, and later New York Life Investment Management, where I moved from operational risk into product management. And that was a very exciting space focused on the mutual fund, the ETF, the alternative investments landscape. And then I came over to Cerulli Associates in 2018 in order to build out the exchange-traded fund, ETF coverage, as well as the very, very exciting space of alternative investments. And over the last few years, we've made our alternative investments coverage more and more retail focused as our asset management clients have really zeroed in on that space in particular. So it's been an exciting ride.
And just maybe a little bit on Cerulli. I know you folks pretty well. I'm a consumer of a lot of your research, but maybe you just describe a little bit about what the model is. The listeners, when they hear it, they might think of a prequin or a pitch book. I don't know if they're in the competitive universe or not. And if they're not, maybe how you differentiate yourself.
We're very different from some of those firms. We are well known in the industry as publishing and consulting providers, specifically within the asset management and wealth management spaces. So as a firm, those are our two key focuses. And what we provide to the industry, every year we survey approximately 2,000 advisors. This is the longest running, most completed advisor survey in the industry. And that allows us to generate a tremendous amount of insights into how advisors manage their practices and how they manage portfolios for their clients. So we take that data, we combine it with tremendous surveys of asset management industry executives, tremendous count of interviews, and together that allows us to paint a supply and demand picture for product. It allows us to understand key wealth management industry trends. And specifically with regard to alternative investments, allows us to cover this trend really from both perspectives of the asset manager, the advisor, and understanding of how an investor is impacted by all this.
Maybe slightly off topic in terms of avenues I wanted to pursue, but it might be helpful if you had some insights, Daniil, on the advisor market. And I grew up in the institutional world, and this is going back 40 years ago, and it used to be described as a cottage industry. There were a lot of small advisors. The whole institutional space was born out of ERISA. Many of these assets were managed inside banks and insurance companies. Nobody even had 5% market share. And the thought back then you'd have $1 trillion club was just nowhere near even the wildest imaginations. And I wonder if in the phase we are with advisors, if you would describe it as a cottage industry. I know there's some bigger players. It seems to be a bit opaque to some degree in trying to track down these 2,000. And when you say 2,000 advisors, I don't know if that's 5%, 50% of the overall population.
You have several 100,000 advisors in the US, and they exist across a variety of channels. You have wirehouse advisors, you have broker-dealer advisors, you have advisors who have established RIAs. So depending on how you calculate this, and of course we have a report that will point to all these numbers and walk you through them, that count can change quite significantly. I would say this is in no way a cottage industry. This is a very diverse industry composed of hundreds of thousands of individuals that provide financial guidance to investors. And it's grown tremendously over the years. And it's happened in line with some key industry trends, which is that retail client assets, this is those assets that are intermediated by financial advisors, are on track to outpace institutional industry assets. So retail channels have grown significantly. We've seen growth in wirehouses. We've seen the build out of the RIA channel. So this is all taking place as investors have greater wealth, and this wealth is being managed by financial advisors.
Maybe this would be a good segue to why the value proposition should be in place. And I just miss the defined benefit era. Even when I started with Bear Stearns and BNY, or it was Mellon Bank before BNY, I do have a very modest DB plan. It probably won't fill up my gas tank when I finally start to collect it. But somewhere around the late 1970s, early 1980s, the world shifted for most of us from a DB plan to a DC plan. And we had to manage our retirement on our own through a series of typically mutual funds. And it took a long time to educate the individual to get away from GICs and also from maybe employer-related stock ownership options. But we eventually got people to think about diversification into the equity markets, and maybe at some point that was overplayed. But while we were doing that, the equity markets used to be the home of capital formation. But trends started to develop, probably driven by institutional money, where more and more capital is flowing into the private markets. The need to go public was not nearly as urgent as it might have been just 10 years ago. Companies are staying private maybe twice as long, sometimes never going public in the first place. And when they do, it might be a DPO like Spotify did, so they're not looking to raise any new capital. So it would seem like, and you probably have some data to back this up, that if the new home of capital formation is in the private markets, and the new home of lending, thanks to Dodd-Frank, is no longer the banks, it's more of the private debt, private credit space, we should have access to that. There are challenges, but maybe you could talk about some of the data and trends you've seen there, and then we can talk about how we're going to potentially try to solve for that.
Yeah, Bill, you bring up a tremendously interesting dilemma here. On the one hand, private capital markets are growing and they're becoming more and more important to the ecosystem. At the same time, you have this reality that investors prefer and are best served by low-cost products. And that's where we've seen the shift over the years. We've seen greater use of ETFs and other types of exposures. So the question is how you can get a greater variety of investors through their financial advisors access to these types of exposures. And it's a battle. So advisor allocations to alternative investments are currently very, very low. You have half of advisors who are not using alternative investments at all for any clients. They're just not using these types of exposures. The advisors who are using them, it depends on the core market of the investor that they're trying to serve. But in general, you will see an allocation of approximately 3% to illiquid alternatives, specifically for the average advisor. And of course, that grows significantly for those who have wealthier clients, high net worth focused advisors, etc. So those allocations can be around 10%. They can be much higher. But across the industry, the allocation to alternative investments is low, and it's taking place for a number of reasons. In general, alternative investments are illiquid. There's now this wave of, call it evergreen product, semi-liquid alternative investment product. So that's more suitable for a wider variety of investors. But at the same time, these are exposures that are complex. It takes a lot of due diligence to understand them. These are exposures that, again, are expensive. They have a lot of costs that are built into them. And of course, they're expensive to run. That's because of the intellectual capital that goes into them. But this is happening in a world where investors have won out by purchasing ETFs that trade in the single basis points.
And I think some of the entry points may be obvious, but maybe on the flip side, maybe something we have to shed light on rather than try to manage around them. I looked at some of your data, Daniil, and I may not have interpreted right, so you can feel free to correct me. But one of the data points I saw is the advisor view on the most reported challenges when they're thinking about accessing alts. And number one was the lack of liquidity is not suitable for clients. And it's almost like saying, you know what, I love Taylor Swift, but I need to go to a concert where there's no noise. You can't have it both ways. And I think if we're going to allow access, I think we've got to do a much better job of explaining why these are meant to be long-term investments, and the money in the ground earns IRR. If it's not in the ground, it doesn't. And the more leaks in that bucket, I think the less attractive the outcome is going to be. And it almost seems to be a threshold thing that we have to solve for. And if you don't like the noise that Taylor Swift, or you don't like lack of liquidity, you shouldn't play the game in the first place.
Yeah, we could go on a 20-minute tangent here and just discuss if the illiquidity premium even exists. I'm not sure what the Kaya materials say about that particular topic. But yeah, speaking to this lack of liquidity, you have this reality that advisors need to have very complex conversations with their clients in order to explain some of these investments to them. It starts in day one of a relationship. So they have to judge whether that client is able to take on the liquidity that's associated with such investments. And a lot of this is going to come down to regret aversion. What the advisor really wants to avoid is placing their client in a particular product that a year later, the client wants to take their money back and isn't able to. And that just creates that point of friction in the relationship. So that regret aversion element is actually very, very concerning. And it's something where you have had advisors over time get burned by some alternative investment products. And because they're only using one or two of these alternative investment products, that's an experience that really stands out to them. It's so fresh in their minds. So that's something that our industry is going to have to work through over time.
Yeah, and I wonder, again, I don't know if it's a fair comparison or not, Daniil, but if we were creating the concept of mass home ownership through mortgages, but we've somehow put these houses on a T+1 trading platform, the market would be a goddamn mess. And the biggest investment we make as investors in many cases is our home. And we're not only comfortable with illiquidity, high transaction fees, but it's typically levered up the wazoo. So for some reason, we've been able to get comfortable with that. And maybe I have a tendency to oversimplify things, but if I'm sitting down with any individual, they've accumulated some level of wealth, there's got to be an outer ring that they're not going to touch for many, many years, or maybe for many high net worth people, it's going to be part of their estate to the next generation. And they should be looking for the very best investment opportunities and stay invested. As Warren Buffett says, my favorite holding period is forever. Those concepts, I don't think they're that hard to at least explain. Maybe mentally getting people to accept that for a longer period of time is where the challenge is.
It's a unique conversation because you're perfectly right. 97% of that investor's portfolio is going to be perfectly liquid with daily liquidity that they do not need. So why the overfocus on ensuring that remaining 3%, call it 10% on the road, is perfectly liquid? It doesn't make sense. But simultaneously, a lot of what advisors do is manage feelings and manage client expectations. And that's where it becomes an issue.
To protract that even more, if I say, well, no matter what I do, this particular client or this particular segment is never going to understand matching that lack of liquidity to the liability side of your balance sheet. So I'm going to create a liquid version of this. And that can come in several flavors. It may exist, and you could tell me, I think putting any kind of private market holding into a 40 Act fund has got a lot of peril associated with it. But even interval funds or drawdown funds, having that kind of a liquidity window where you could have 5% a quarter, 25% a year that could leak out, that doesn't sound like it's destined to be a very good and differentiated outcome to the end investor.
I'd say it really depends on the strategy and the structure that you're using. We've obviously seen the tremendous growth in the non-traded REITs, non-traded BDCs, interval funds, tender offer funds. Tender offer funds specifically don't really have to offer that liquidity. They don't have to offer the 5% quarterly. They can offer liquidity at will per predefined terms. So that may be a structure that has been used for a variety of private equity exposures. And you also see managers move into operating company structures, and they're continuing to explore different ways of offering that liquidity. I'd argue it's a good thing to offer investors that option of having liquidity, right? To the extent that perhaps the typical 12-year, 15-year term for a private capital fund may indeed be tying up capital for just a bit too long, where institutional investors already have access to secondaries, etc. So I'd argue this is a good development in terms of providing these types of exposures to retail. But you're perfectly right where, yeah, can the liquid alternative product or can a semi-liquid product offer the exact type of return profile as what institutional investors are getting? Probably not exactly.
I want to talk about the time we're in now in terms of some of the market trends. But before I get there, another survey factoid, and maybe I pulled some of these out of context, Neil, so I said you can take these at face value. But there was another survey about what is driving interest in the allocation to alts. And the number one cited case, and it was 81%, if I wrote this down correctly, I think this is the advisor speaking, revenue generating potential. That sounds like a decidedly anti-client observation. Now, I will say number two, 77%, almost as much was to optimize risk. And I assume that means better risk-adjusted returns, less vol, less drawdown. But if the overarching goal is to improve the advisor's fortunes, I just don't know if that's always going to be aligned with the client's interests.
Yeah, this is taken just slightly out of context, where this is the asset manager perspective, not the advisor perspective.
Okay.
So a key component of this push to offer more retail alternative product is that traditional institutional channels, as we mentioned earlier, are growing less quickly than retail wealth channels. So if you are an alternative investment manager, you have come to the realization in the last few years that institutions just can't allocate that much more to private capital. And instead, you have to look toward this retail capital pool, which has been over time very much underpenetrated, and to look to them in order to grow your business. And the alternative investment managers have made this realization at the same time that the traditional managers who are legacy mutual fund ETF providers have recognized that, look, the fees have gotten so low, we need to grow an alternative investments business in order to generate attractive revenues. This is managers saying, look, we want to serve these financial advisors, etc., but for their growth strategy, offering alternative investments to retail clients, generating attractive fees is certainly an important component of that. And within that, they realize that there is this great investor need for diversification, downside protection, greater income. This is the second part where alternative investments can play a very important role.
I don't know if this falls under the law of unintended consequences. And I'm not going to argue, at least for the moment, that alternative fees are too high. But if I look at it the other way, in public markets, fixed income and public equity, you can get access to virtually any index for a handful of basis points. And why is that? A lot of reasons, but I think it really comes down to the fact that the markets are so super efficient, very, very hard for an active manager to consistently beat the bogey, although there are some that do it. So the investor is not willing to pay a lot. They're better to buy the index. If I think about all of the money that's flowed into the private markets, say just since the GFC, so going back now maybe 15 plus years, it's a lot. And you could probably put a dollar sign on it better than I. And I think that does bring a lot more efficiency into what was once a very inefficient market. And when the David Swensons of the world and the Ford Foundation and the Common Fund were first winding up around the endowment model almost 60 years ago, there wasn't a lot of competition. There was asymmetric information advantage. I could go and probably pick off any portfolio company I wanted at maybe 4 or 5 times cash flow and sell it for 12. But now there is competition and there's more efficiency. And broadly speaking, the median numbers in private equity and venture, even in private debt, to a large degree are undifferentiated from the public market proxy. And you might say, and I've heard some GPs say to me, oh, no, there's a premium of 300 or 400 basis points. And I say, well, I think you talk about an apple and orange because it's IRR over here and it's time-weighted return on this side. And if you rinse that through the lens, have we had anything differentiated? And maybe to throw one more thing in that pile and then I'll stop. I speak a lot, as you know, as you do, and I bump into you a lot and speak to a lot of very, very smart GPs. And while the median numbers are undifferentiated, you never run into a median manager. The median numbers are the median numbers. And unless you have a skill, a partner, dumb luck, your ability to pick something above that median is going to be very, very low. So I think with all this efficiency coming in, all this capital flowing in, the median numbers, does the investor have a fair chance from a standing start to get something differentiated in the first place?
Yes, but it's going to be difficult. And it's going to change as the industry evolves. I love to hear you making this argument of, look, private markets are growing. Do they eventually slowly become beta? And you're probably right. There's no median manager. You have investors who are fighting to get into the top products, and they increasingly have better ways of doing this. They can work with platforms such as iCapital, Case, AIX, etc. They can secure a master feeder fund into one of these exposures, or increasingly they'll have access to these products directly through structures such as tender offer funds. So this is all happening. Yeah, over time, do these returns, I wouldn't say they are watered down, but over time, they do become looking a little bit more similar between who perhaps the top performing manager is and others. But I think there's also this argument here in the private capital industry around these exposures are all actually very different from one another. So a private equity strategy can be very, very different from one firm's strategy is going to be very, very different from another firm's strategy. And you obviously have middle market strategies. You have a focus on specific niches in the market. So when you have that niche focus, that really differentiates you. And I think advisors very often do look for some of these much more niche offerings as opposed to being put into a large fund from a private capital manager alongside other investors. I think that's something that advisors spend a lot of time on. It doesn't always end well because you can go too niche, but simultaneously, I think there's a very important argument here about private capital markets becoming beta as we move into the future. But simultaneously, we have to keep in mind that this is a very, very diverse market with a lot of unique niches across.
Point well taken. And maybe to throw a bold underscore, you just referred to it, I think, intentionally as a market, not an asset class. And if I'm thinking as an advisor or a client of an advisor, I need to have 8% or 12% exposure to private equity. I'm not even sure what that statement means. And you may find less inefficiencies, more alpha in the middle markets as opposed to buyout, or maybe growth, or maybe late stage VC if you can handle the risk quotient there. You've got to ask maybe that second or third level question to really understand what you're buying and maybe give the advisor, who hopefully is on top of this anyway, the fact that not all portfolio companies and strategies are created equal.
That's exactly it. If you look at just private credit is 20 different things. It's direct lending, but it's also asset-backed finance. It's also lots of different types of strategies, and every single one of them is going to be different, and firms are going to provide very unique offerings. So you can certainly buy something that's very, very high level that gives you access to private credit with one ticket, but simultaneously there is a great variety of other strategies there. And you're going to have managers who build an expertise in those subsegments.
Getting back to the institutional approach, which I think all investors to a large degree would do well if they could mimic it, but this concept of vintage year diversification. So some are better than others, and you want to be involved in each one, and each one has its characteristics. Maybe the jury is still out on 2024 as to whether it's a good year or not. I think there's a lot of dry powder sitting on the sidelines, and I agree with the point you made yesterday. I think anybody that's explaining an illiquidity premium to a client is doing them a disservice. I just don't know if you could put a number on it. And it's lower than it once was, maybe back in the good old days when you could measure it. But you've got all this liquidity sitting on the sidelines. And then two very interesting data points. And again, maybe out of context, but the numbers are too big to ignore. I saw something S&P put out not that long ago, and there's $7 trillion of debt maturing across the overall debt capital stack in the next 36 months, $7 trillion. And I think 20% of that stat at speculative or below. So that all has to be refinanced or paid off. And then Bain came out last week with a very interesting data point. Nobody seemed to take the other side, that there's $3 trillion of equity tied up in 28,000 portfolio companies. And I think 40% of them have been moving in that sell window 4 to 5 years old. So 7 plus 3 is 10, and I put $1 trillion moniker next to that. That's about a third of GDP. It's 20% of the market cap of the public equity markets. And to think all that merchandise is going to be moved at NAV, I think it's delusional to think that way. So I guess maybe tucked inside is your observations on some of those data points, because you probably have more informed views than I. But are we running up against a liquidity window that's going to be very, very busy? And would maybe some mindset be, let's let some of this stuff sort out. And if you could be a provider of liquidity, and I'll come back to this because there's a couple interesting things I saw that play into this, but if you could be a price maker as opposed to a price taker at this stage of the market, you could be sitting in an awesome spot.
Yeah, it's a really interesting moment in time for private credit, given the amount of demand that there is for these types of exposures. And I think the industry is, for what it's worth, very, very much aware of the risks of some of these strategies. I think it gets a lot of media coverage. It gets a lot of discussion. There are a lot of concerns around the valuation of the underlying loans. There was recently a very interesting Bloomberg article about this and how sometimes a private capital firm can have a loan on the books at a different valuation than a public entity would hold that loan on the books. You have a lot of very interesting coverage of this. I think what's important to remember is that, to your point around being a capital provider, the providers of capital to the private credit ecosystem are very much increasingly individuals. These are very, very wealthy individuals. These are individuals who are purchasing these products. These types of exposures will sometimes take on leverage, but the initial capital as provided by the investors is not leveraged up 30 to 1 as a bank might do. So for what it's worth, you have wealthy investors who are providing the capital for this ecosystem. They have the ability to bear some amount of the loss. Simultaneously, you have private credit firms who are absolute experts in potentially, holding the debt through a distressed event. So that gives them greater ability to potentially receive better terms, to have a better workout as a result of the situation. So those couple of things make us incrementally more comfortable about the ecosystem. So it does appear frothy. We've had executives at these firms tell us that valuations will appear frothy, but simultaneously, these are non-heavily levered exposures from wealthy individuals.
This is going to be impossible, I think, other than maybe the highest of high net worth, Daniil, but maybe two related examples that I saw, which I think could be very interesting entry points. So the Norway Sovereign Wealth Fund, 1.6 trillion, has gone to the sovereign, and for the very first time is seeking permission to put 5% to work in the private markets, and specifically private equity. So quick math, that's $80 billion. If they came in and just sloppily signed up for Fund X+1 from any one of these GPs, I don't know if that's going to be very interesting. But if they came in, it could be a liquidity provider, maybe a very interesting story. And then the other data point, just anecdotally, is the Abu Dhabi Investment Authority is now the price maker for people looking to get out of China. So a westernized organization is trying to leave, they can't get out, and Abu Dhabi Investment Authority has a price for them. They may not like it, but they're probably the only one operating that liquidity window. So there's maybe some flashing yellow lights, maybe some red, depending on the investor. But I think for maybe the smart institutional money, there could be some interesting entry points here. So we can just park that all at face value. So a couple of things I do want to touch upon before we sign off, Daniil. You've mentioned a couple of times, maybe just by reference or inference, the ETF space. And I know that Cerulli travels in this space as well. It would be so wonderful if we could create a family of ETFs to replicate the beta in these private markets where you could get in and out, trade all you want to be done very inexpensively. Maybe you could do that with some equity long short and maybe some structured product exposure. I'm not sure if we're ever going to get to being able to replicate that exposure in the private markets. Maybe you could have a small cap focus with some kind of an options overlay. But if it's liquid, I just don't know. Do you ever see the day where at least there's some access to create investable indices in this space?
For what it's worth, I wish that the industry would stop trying to package illiquid exposures in liquid structures. There is a reason that some of these exposures have those liquidity lockups. You're giving the manager the ability to generate value in the long term. And I think we just want to place everything in an ETF nowadays. And I feel like that's just a little bit misguided. I think ETFs are wonderful. They let you buy the market for 7 basis points, but simultaneously, the differentiating point of private capital is that it is not the market. These are exposures that are aggressive in terms of driving value, in terms of what they own. It's a variety of strategies, and none of these strategies are really subject to liquidity. So I think anyone who's buying anything in ETF wrapper or even a semi-liquid structure, they have to recognize they're not getting the same exact thing that an institutional investor would be accessing in that space. ETF structure is absolutely wonderful. We're big proponents of it. I don't think that putting private capital exposures on blockchain or putting them into an ETF product is necessarily the way forward, unless it's a very simple exposure and you're saying that it's private capital like, but not the same thing. You need a lot of disclaimers around it.
So I just want to test a theory, and I've talked to a few other guests on this, Daniil, and your views would be as informed, if not more so than others. If subject to public disclosure, maybe late last year, KKR and maybe Hamilton Lane did the garden variety private equity offering, Cayman-based fund or some other tax-neutral jurisdiction, but then they created a feeder fund on the blockchain. And I haven't fully followed this story, but let me tell you the narrative I find very interesting, and some of the listeners have heard me say this before. So if it's on the blockchain, somebody's going to have to play price referee. It's going to have to be permissioned to some degree. But if you want in and I want out, somebody's going to have to help with price discovery. And there's going to be a bid-ask spread. And if we don't like it, the trade's not going to happen. If we do like it, it does happen. But the fund itself, unlike BREIT, did not have to raise any liquidity at all. So I think it solves for the investor that wants liquidity on demand, and they shouldn't have been in the product in the first place, in my humble opinion. If the vast majority of investors do believe in it, they don't have to worry about these non-believers creating a liquidity window because they're creating it between two investors. So does that argument hold water? I haven't followed the full story as to how these feeder funds have done, but I would assume the NAV in the distributed ledger offering is exactly the same as the NAV in the Cayman-based fund.
I haven't tracked it too closely, but we did spend a little bit of time on the entire tokenization story and trying to reach the end investor of these types of exposures through the blockchain, or even other direct-to-investor platforms. And our opinion on this remains that alternative investments are very much an advisor-driven sale because they require tremendous education. And we think that firms are taking on a bit of risk by making this available even more to that direct end investor, because the market, based on any of our sizings, just isn't tremendous. Individual investor assets are very often tied up in their retirement plans, etc. So you end up targeting what are mass affluent investors, and there's just not a tremendous pool of capital there to make an illiquid alternatives allocation without a financial advisor. It doesn't seem like the most attractive opportunity to us. It does seem risky to have an investor be able to pull up a quote for your fund, which is 40% below its current NAV. And that's actually what's happening. You have listed products on the London Stock Exchange. You have listed private capital funds, and they're all trading at very significant discounts, very similar to exchange-traded closed-end funds for what it's worth. There's some amount of fee amortization going on there into what you see in the discounts. I think it's incrementally less attractive to managers to sell product that way versus working with a financial advisor, especially as financial advisors are so central working with end investors, and especially on the upper range of the wealth tiers that would be allocating to us.
Well, it's something that is worth paying some attention to. I agree with you, Daniil. It is early, but maybe by comparison, if I look at how active the secondary space is, LP and GP led, coming out of the GFC, that was a distressed window. That's where you went when you had to get liquidity holding your nose, and you would get maybe 60 cents on the dollar. And that's become a much more efficient space and maybe a very good entry and exit point for many allocators into the private market. So stay tuned there. Look, a few things I'd like to cover, but we're coming up against time. One of the things I joke with you about, but meant in earnest, is every time I see you, I say, Daniil, this transfer of wealth, and has it gone up another $10 trillion? And this is from the baby boomer generation, where I'm right at the end of that generation, is passing down a tremendous amount of wealth to the next generation. And that number used to be pegged at 60. I think I saw a report that Cerulli put out not that long ago, was in the low 80s. It might even be higher. There's been a lot of household wealth accumulation since COVID. So I think that continues to push this number up. And just to put some context, I think I mentioned this in one of my stops when I saw you not too long ago, is that $80 trillion is more than 1.5 times the market cap of the US equity markets. And it's almost 3 times global GDP. So no matter how you cut it, this is a massive, massive number. And I know it's a little bit of a double count because some of it's coming out of the public markets and maybe going back in again. But this next generation is a very different breed of investor, and they're definitely much more socially conscious, environmentally conscious. They may be thinking about impact investing. They may be more open to investing in the private markets. So maybe just confirm the size. And if it's over 100, I wouldn't be shocked by it. It keeps growing. But the size of this wealth transfer and how you see that playing into democratization, because this is a huge amount of assets in the hand of the individual. I'm very interested from my own balance sheet standpoint, because when I'm 6 feet under, I'd at least like to get some insight into what my kids are going to be doing with my own personal balance sheet, and hopefully not going long all into Bitcoin, but we'll see what happens.
Our latest number here is an $84 trillion wealth transfer, and this is taking place on the back of Americans becoming increasingly wealthy as a result of their working hard, market returns, some amount of inflation. You have a very significant figure there in terms of what's going to end up going to Gen X, millennials, eventually Gen Z. You're right, it's a perfectly significant sum. I would say it certainly is important. What I think is important here is advisor succession. So first off, advisors need to have a plan for their own businesses in terms of how they're going to continue. A very high amount of financial advisors that are nearing retirement age, and they need to have some kind of plan to keep that business going down the road. In the meantime, they also need to work with their younger investors in order to make sure that they keep that relationship after the primary account holder, either through this wealth transfer, after that primary account holder passes away, etc. That's a very important thing for financial advisors to be focused on. There is a story here around the ability for financial advisors to use alternative investments as a way of deepening the relationship with their clients in order to keep that relationship momentum going. And if you do have a generation of investors that is increasingly focused on some of these ESG themes, impact investing, etc., I don't want to overplay this theme at all, as it's only important to a select group of investors and a select group of advisors who may be focused on those investors. But where there is room for it, private capital is an incredible place to make a difference by allocating to some impact fund product. When we go on to public markets and we buy our little electric car company stock, we're not necessarily making a difference. But when you fund a windmill farm, when you provide funding to a impact infrastructure exposure, that's very, very different.
Yeah, I agree. Maybe last thing off this topic, but this interview is going to probably air in a few weeks from now, but we're here in late March. And I haven't had a chance to read it yet. Maybe you haven't either, but Larry Fink came out with his annual letter and he's moved away from ESG. What a big surprise. But he's focused on the broken retirement promise. And I heard a panel at Alts LA when I was out there last week, and it was an excellent discussion around an area where we're not paying near enough attention. And a lot of what we talked about is access. But I assume in the Cerulli 401k plan of mine as well, all I can get is garden variety, undifferentiated equity and bond funds, full stop. And maybe in my target date fund, I can get 15% illiquidity. But I think we've set the investor up to largely fail if the vehicle they have, and no matter how good of a job we do in education, if most of the retirement assets are inside a defined contribution plan, the litigation bar is high. There's no incentive for the fiduciary to create avenues in. And I don't know if you have a view in that. I say we're not going to solve for that in the remaining seconds we have. Something that we are going to explore more and probably do some panel discussions on this, but it would be great if you had a view or two on that.
We're very focused on the adoption of alternative investments in DC plans. You brought up some very, very interesting and difficult to deal with challenges in this space. Investors love their target date funds within the defined contribution plan space. They love the ability for the fund to do everything automatically. And what's great about these funds is they're so low cost. And alternative investments are just a tough fit for that. So eventually it's going to take quite a while, but firms will spend more and more time focusing on this down the road. There may be a small alternative investments window that opens up within a target date fund. So I think it's going to be a channel that takes a while to open up, but it will eventually happen for more alternative investment exposures. And that will leave investors hopefully that much better served.
Here's a crazy idea for you. If we had a sovereign wealth fund in the U.S., maybe they could go and spend $3 trillion on these 28,000 portfolio companies and create a market and access to the private equity space. And 28,000 companies is probably almost 10 times the listing of public companies that we as investors can get access to. So a wild idea that's got no wings, but it's going to take creative thinking. And I just find when you get in a certain zip code around Washington, D.C., creativity goes out the window no matter who's in charge. So we'll hope for the best and we'll try to solve that, Daniil, next time I have you on. But a great discussion. Keep up the great work. And I appreciate you joining me today.
Thank you so much for having me on the podcast. The feelings are absolutely mutual. It's delightful to chat with an industry expert in the space.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.